Today, we're diving into one of the most interesting signals you can find on a financial chart. It tells a super dramatic story about a battle between buyers and sellers, all packed into one trading session. And it all starts with a simple shape, a T.
So you see this little T on a chart? What can it actually tell you about where the market is headed? I know it looks pretty unassuming, but this specific pattern can be a massive clue that the momentum is about to shift, and shift in a big way.
All right, let's break this down. First things first, what exactly is this T-shaped signal we're looking for?
Okay, so this pattern has a name. It's called the Dragonfly Doji. And what makes it a Dragonfly Doji is simple. The price where it opened, the highest price it hit, and the price where it closed are all basically the same, squished together right at the top. This creates that tiny little body, while that super long lower tail, or shadow, shows you just how far the price crashed before buyers rushed in and pushed it all the way back up.
And here's a cool little fact. Its original Japanese name, Taketombo, means bamboo copter. You know, one of those little toys you spin in your hands and it flies up? It's kind of the perfect metaphor, because just like that toy, the market's direction after this signal can be, well, unpredictable. It could shoot up or it could just fall flat. It's a great little reminder of the volatility it represents.
So what story is this one little candle actually telling us? Well, it's a story about an incredibly intense battle between the buyers and the sellers. I want you to think about it like a game of tug of war. The session opens, and right away the sellers just take complete control. They yank the price way down, and that's what forms that long lower tail. But just when it looks like it's over, the buyers dig their heels in. They come in with incredible force, stop the fall, and start pulling back so hard they drag the price all the way back up to where it started. So the most important part of that story is the powerful rejection of lower prices. The market went down, took a look around, and the buyers essentially screamed, "Nope, not happening. This price is way too cheap." This outcome is a huge sign that the sellers might be totally exhausted and that the entire sentiment of the market is about to flip.
But, and this is a really big but, a Dragonfly Doji all by itself doesn't mean a thing. Its location on the chart, that's what gives it its real power. Context is absolutely everything.
Just look at this comparison. When you spot a Dragonfly Doji at the bottom of a long, clear downtrend, especially if it's near a known support level, that's a very powerful bullish signal. On the other hand, if you see that exact same T shape in a market that's just drifting sideways and not really going anywhere, it's basically meaningless. It's just noise signaling indecision, not a powerful reversal. And this brings us to probably the single most important rule for using this pattern, or honestly for any candlestick pattern. You have to wait for confirmation. The doji is just a signal of a possibility. It is not a guarantee.
Okay, so you've spotted a promising Dragonfly Doji in the perfect spot. What now? Well, let's walk through a quick practical checklist of how you might approach it.
Okay, here's the play-by-play. It all starts with identifying that clear downtrend. Then, you spot the doji near a support level. But step 3 is the crucial one. You wait. You need to see a strong bullish candle on the very next session. That's your confirmation. Only after you get that would you even consider entering a position. And you would always set a protective stop loss just below the doji's tail. That's your safety net. And here's another layer of proof you should look for. Volume. A Dragonfly Doji that forms on high trading volume is way more reliable. Why? Because high volume means a ton of people were involved in that tug of war we talked about. It means the buyer's victory wasn't just a tiny skirmish, it was a major battle, and that makes the outcome much more significant.
All right, we need to be realistic here. As powerful as this tool can be, it is absolutely not a crystal ball. So let's cover some of the really important limitations and risks.
So there are a few key things you've got to keep in mind. First, a picture-perfect Dragonfly Doji is actually pretty rare. Also, while it might signal a bottom, it gives you zero information about how high the price might bounce. False signals can and do happen even when you get confirmation. And finally, its effectiveness can really change depending on the market you're in. Stocks, Forex, crypto, they all behave a bit differently.
You know, a great way to really understand something is to learn its polar opposite. For the Dragonfly Doji, that's the Gravestone Doji. It's just an inverted T. It tells the exact opposite story. Buyers pushed the price way up during the session, but then sellers came in and slammed it all the way back down. So the Dragonfly signals a potential bottom, but the Gravestone signals a potential top.
This leads us right to the common mistakes people make.
The biggest one, by far, is trading without waiting for confirmation. Other big ones are ignoring the overall trend, remember, context is king, forgetting to set a stop loss to manage risk, and relying only on this one pattern instead of using it with other tools. Oh, and misreading the signal when there's no volume to back it up? That's a classic error.
So what's the ultimate takeaway here? A pattern on a chart, no matter how convincing it looks, is only signaling a possibility. It is never a promise. The Dragonfly Doji tells a fascinating story of a potential turning point, but it's just one clue in a much larger puzzle. The real skill is learning to tell the difference between a meaningful clue and just a random coincidence.